Markets have begun the year positively, with global equities up around 5% in local currency terms and 10% in euro terms, while European bonds have risen just over 3%. Gains have been driven by the larger than expected asset purchase programme from the ECB, improving economic news flow outside the US, and progress towards a temporary resolution of the Greek bailout programme. The ECB had hinted that a sovereign bond purchase programme would be announced when President Draghi suggested it would be acting illegally if it did not pursue its policy mandate of a 2% inflation target, and indicated the decision to implement a quantitative easing programme did not need to be a unanimous one. It eventually surpassed expectations when announcing an asset purchase programme of €60 billion per month, which will last from March 2015 to September 2016. But in effect is open-ended, as it will continue until such time as inflation moves sustainably back to the ECB's 2% inflation target. With this announcement, liquidity being provided by G4 global central banks will be running at double the average level of liquidity provided over the last 3 years, and is only exceeded in size by the initial launch of QE1 in the US at the height of the financial crisis. This should be supportive of economies and equity markets, particularly in Europe. Elsewhere, monetary policies remain accommodative, with 12 central banks reducing interest rates year to date, facilitated by ongoing low levels of inflation on the back of the low oil price. The Greek government was elected on a mandate to obtain a write-down of the greater part of Greece's debt and reduce austerity within the existing bailout programme. The Troika has refused to grant a write-down, as if it did so, other countries would likely seek write-downs of their outstanding debt, which would result in significant dislocations in bond markets. The Troika has also insisted that existing commitments to improve the Greek fiscal situation be maintained. Both sides initially adopted defiant negotiating positions, but with the Greek banking sector experiencing significant deposit outflows, and Greek government funding set to run out with the ending of the existing programme at the end of February, a temporary compromise has been reached, with Greece applying for a 4-month extension of the existing bailout programme. This gives time for a new bailout programme to be agreed, and we believe an ultimate compromise will be reached, which could include further extensions of loan maturities, lowering of interest rates charged on loans, an extension of interest-free periods, and potentially some swapping of debt into bonds where the level of interest rate is linked to GDP growth. This would entail the Greek government making far more concessions than the Troika relative to the original negotiating positions, driven by the significant negative consequences for Greece in the event of a failure to secure a package and being forced to ultimately leave the euro. Economic news flow has changed somewhat, with recent data in the US being softer as growth in Q4 slowed to about a 2% annualised pace from just under 5% in the middle of the year. However, with the labour market at its strongest in over 15 years, the economy remains well underpinned. This softness has been partially offset by improvements elsewhere, particularly in Europe, where most business sentiment surveys have rebounded close to 12-month highs, consumer confidence has risen to a 7-year high, and retail sales are growing at the fastest pace in 8 years. With the weaker euro, Q4 Eurozone GDP growth exceeded expectations at 0.3% quarter on quarter, and current indicators suggest the Eurozone could be growing close to a 2% annualised pace by the end of 2015. In Japan, the economy recovered from 2 negative quarters of growth to grow 2.2% annualised in Q4, and with stronger investment, production and consumption indicators, looks set to grow 1 to 1.5% in 2015. Recent sentiment indicators have also improved in the UK, suggesting growth could be closer to 3% again in 2015. Overall, despite the softer US data, the global economy looks set to grow by 3% or more in 2015, supported by the positive boost from the lower oil price. Equity markets still provide upside, supported by the significant liquidity being provided by central banks. While equities are close to historic averages on an absolute valuation basis, equities remain extremely attractive relative to other asset classes, particularly bonds, as highlighted in these two charts. The first chart compares equity valuations relative to bonds by dividing the global equity dividend yield by the yield on US 10-year treasuries, a proxy for global bonds. Anything above the average line shows equities are attractive, and at current levels suggests there is still upside in equities to get to fair value versus bonds. The second chart compares regional equity dividend yields against the 10-year bond yield in various markets, and with the exception of the US, the dividend yield on equities significantly exceeds the yield available from bonds. As the search for yield in investment markets continues, investors can obtain this higher yield in equities rather than sovereign bonds, while in addition, equities also offer growth opportunities. In relation to bonds, while yields are close to all-time historic lows across Europe, given the size of the upcoming ECB asset purchase programme, which will buy up to twice the net sovereign issuance across the Eurozone, and with inflation and inflation expectations likely to remain low, the upside in yields is probably capped in the short term, with yields remaining in a tight range through much of the year. With an improvement in European growth through the year, there could be some upward pressure on yields towards year end, although this is likely to be modest.